SCHD is up 13% in 2026. Let that land for a second. While the S&P 500 is barely positive and the growth stock crowd is sitting flat, watching their portfolios go absolutely nowhere, dividend investors are up double digits, and that fact alone is why today's video matters more right now than it would have at almost any other point in the last 3 years, because the rotation is real, the money is moving, and if you are in the wrong dividend ETF at this moment, you are watching that rotation from the wrong side of the trade. Today I am settling the biggest debate in dividend investing once and for all: SCHD versus SPYD versus VYM. I ran the full numbers on all three using a $100,000 investment projected out to 30 years, and one of these ETFs has a problem that almost nobody in this space is talking about, a problem that is sitting quietly inside the most attractive headline number, the highest yield, and that could cost you over $1 million by the time the dust settles. If you are within 10 years of retirement, already retired, or building toward a dividend income goal, this is the video you need to finish before you make your next move. Let me start with the number most people go straight to when comparing dividend ETFs, because it is the number that creates the most confusion and the most costly mistakes. That number is current yield. How much cash actually lands in your account from day one on a $100,000 investment in each fund? SPYD comes out swinging at approximately 4.8% yield, putting roughly $4,080 into your pocket in the first year. That is about $340 every month in passive income. SCHD sits at approximately 3.3%, generating roughly $3,300 annually, about $275 per month, and VYM brings up the rear at approximately 2.26%, giving you roughly $2,260 per year, which works out to about $188 monthly. On pure headline income alone, SPYD wins by a landslide. It pays you $1,820 more per year than VYM on the exact same $100,000 investment. Before I show you what flips this entire picture upside down, I want you to lock in your gut answer right now based on yield alone. Drop a comment, SCHD, SPYD, or VYM, because I am about to show you why the obvious income choice may actually be the most expensive mistake you can make. Here is where most financial content gets this comparison completely wrong. They show you the yield, highlight the highest number, and move on. But choosing a dividend ETF based purely on current yield is like accepting a job offer based solely on the free lunch, while ignoring the fact that the other offer pays $20,000 more per year. The lunch is real. The income difference is also real. But they do not operate on the same timescale, and they do not compound the same way. To see the full picture, you have to look at what actually happened over the past 12 months to a $100,000 investment in each fund, and when you run those numbers, the yield story gets complicated very quickly. VYM, the fund with the lowest yield of the three, delivered a one-year total return of approximately 20.57%. Your $100,000 turned into $120,570. That is a $20,570 profit. SCHD returned approximately 16.12%, turning your $100,000 into roughly $116,120. And SPYD, the income king at the top of the yield table, returned approximately 10.15%. Your $100,000 became $110,150. VYM, the fund that pays you the least in dividends, made you $10,520 more than SPYD over the past year. All of that extra dividend income from SPYD got completely swallowed by VYM's superior price appreciation. The fund that looked worst on the yield comparison turned out to be the strongest total return performer over 12 months. But here is where 2026 changes everything, and why the conversation is more interesting right now than it has been in years. Year-to-date in 2026, SCHD is up approximately 13%, absolutely crushing both SPYD at around 6.68% and VYM at just 4.72%. The one-year total return champion VYM is actually the weakest performer so far in 2026, and SPYD, the fund many people write off as a slow-growth income vehicle, is beating VYM year-to-date. The winner changes every single year. The fund that won last year is underperforming this year, but here is what all three of them have in common right now. They are all beating the S&P 500, and it is not even close. SCHD is outperforming the S&P by roughly 12% year-to-date. SPYD is ahead by about 6%. Even VYM is outperforming by about 4%. If anyone ever told you dividend investing is boring or outdated, hand them these 2026 numbers. The great rotation from growth into value and dividend-paying stocks is real, and it is happening right now. For the first time since 2022, capital is leaving overvalued technology names and finding its way into the kinds of businesses that SCHD, SPYD, and VYM have owned quietly for years. Now, let me take you under the hood of each fund, because these three ETFs look similar on the surface, but they are built around completely different philosophies and completely different sector bets. Understanding what each one actually owns is what tells you when to own it and why. SCHD is fundamentally an energy and consumer staples play. Its current sector breakdown puts approximately 21% in energy, nearly 19% in consumer defensive, and 16% in healthcare. Its top holdings read like a list of businesses that have been paying and growing dividends through multiple recessions: Lockheed Martin, ConocoPhillips, Verizon, Chevron, Bristol-Myers, Squibb, Merck. Each of those top positions sits between 4 and 5% of the total fund. SCHD concentrates its bets. The top 10 holdings account for approximately 42.5% of the total portfolio. This is a focused fund that makes deliberate sector and quality calls. It is not trying to own everything. It is trying to own the best. SPYD is built on a completely different philosophy: broad equal weighting across the S&P 500's highest-yielding stocks with a massive tilt toward real estate. Real estate accounts for approximately 25.6% of SPYD's holdings, followed by about 18% in consumer defensive and nearly 12% in utilities. Its biggest single holding, Verizon, is only about 1.5% of the fund, and the top 10 holdings together represent only about 13.85% of total assets. SPYD spreads the risk across approximately 80 companies, each carrying roughly equal weight. This structure makes SPYD extremely sensitive to interest rate movements in both directions. When rate cuts come, and they are expected in 2026, the real estate and utilities sectors that dominate SPYD tend to rally hard. SPYD is not broken. It is rate-sensitive and sector-specific. Understanding that changes how you use it. VYM is the most diversified of the three by a considerable margin, holding over 570 companies across the full breadth of the U.S. large-cap market. Its sector tilt leans toward financials at approximately 21% and technology at roughly 16%. And here is VYM's secret weapon that neither SCHD nor SPYD can match: Broadcom. Broadcom is VYM's single largest holding at approximately 6.95 to 7.5% of the entire fund. Broadcom just reported earnings with revenue up 29% and net income up 34%, driven directly by AI chip demand. That single position is contributing meaningful performance to VYM that neither of its competitors can replicate. VYM is essentially running a conservative dividend strategy with one very powerful offensive weapon hidden inside its 570-plus holding roster. Think of SCHD as a basketball team with 5 superstars, who all play significant minutes. SPYD is a soccer team where every player contributes roughly equally and no one dominates. And VYM is a football team with one elite franchise quarterback in Broadcom and a very deep bench behind it. Now, I need to show you the single most important number in this entire comparison. The number that most investors never look at when they compare dividend ETFs. The number that quietly determines whether your income stream is growing or shrinking while you sleep. That number is dividend growth rate, and it is where SPYD reveals the problem I mentioned at the opening of this video. SCHD has a dividend growth rate of approximately 35% per year over the past 5 years, and has been paying consecutive dividends for 14 straight years without interruption. VYM falls in the middle with a dividend growth rate of approximately 3 to 3.5% annually, and the longest consecutive payment streak of the three, at 19 years. Those are both reasonable numbers, but SPYD, and this is the number that should stop every income-focused investor in their tracks, SPYD has a negative 5-year average dividend growth rate of approximately negative 2.89%. The actual dollar amount that SPYD pays per share has been shrinking for half a decade. Not the yield percentage on a rising price. The actual dollars deposited into your account have been declining. Most people see that 4% yield and think they are locked into a winning income position. They are not. and the 30-year math makes that crystal clear. I ran the full 30-year projections using the actual 6-year average annual total returns from each fund's real historical performance. SCHD has averaged approximately 10.38% per year. SPYD has averaged approximately 7.34%. VYM has averaged approximately 11.08%. Those are real, historical numbers, not optimistic assumptions. Here is what happens to your $100,000. After 10 years, SCHD grows to approximately $268,000. SPYD reaches about $203,000. And VYM grows to roughly $286,000. The gap is meaningful, but not yet shocking. Fast forward to 20 years and the picture changes significantly. SCHD hits approximately $721,000. VYM reaches roughly $818,000, but SPYD is only at about $412,000, less than half of VYM's outcome from the same starting investment. By 30 years, the math becomes almost difficult to believe. SCHD grows to approximately $1.93 million. VYM grows to approximately $2.34 million. And SPYD, the fund that started with the highest yield and looked like the clear income winner on day one, ends up at only $837,000. VYM ends up with $1.5 million more than SPYD over 30 years on the same $100,000 investment. Same starting amount, same 30 years, $1.5 million difference. That is the cost of negative dividend growth and lower total returns compounding against you for 3 decades. But the total portfolio value is only half the story. The income projection over time is where the real lesson lives. In year 1, SPYD pays you the most at approximately $4,080, SCHD pays $3,300, VYM pays $2,260, SPYD is the clear income winner on day 1, and that is absolutely real. But now fast forward to year 10. SCHD's income has grown to approximately $7,528 per year because it is compounding a 5.35% dividend growth rate on top of a growing portfolio base. VYM is generating approximately $6,200 per year. And SPYD, with its negative dividend growth, it has barely moved to about $4,283. SCHD has already overtaken SPYD in annual income somewhere around year 7 or 8, and after that crossover it never looks back. By year 20, SCHD is paying approximately $17,173 per year, $1,130 per month from a single $100,000 investment. SPYD is generating only about $4,126. At year 30, SCHD is depositing approximately $39,175 per year into your account. That is $3,265 per month. And SPYD at year 30, approximately $5,113 per year, $451 per month. SCHD is paying you more than 7 times what SPYD pays at the 30-year mark. 7 times, from a fund that started with a lower yield. SPYD went from $340 per month to $451 per month over 30 years, a $111 monthly increase across 3 full decades. SCHD went from $275 per month to $3,265 per month. And if you add up every single dividend payment collected over the full 30 years, SCHD puts approximately $453,000 of total cash into your pocket. VYM delivers around $177,000, and SPYD gives you just $142,000. SCHD collects more than 3 times the total cash of SPYD over 30 years, and it started with a lower yield. This is the single most important lesson in dividend investing. The highest yield today is almost never the highest income tomorrow. Here's the verdict, and I'm not going to sit on the fence about it. If you are a long-term wealth builder who wants dividends that grow bigger every year and wants the strongest 2026 momentum, SCHD is your ETF. The 2020 might din kain in scan 26 kwan. Rotation into energy, consumer staples, industrials, and defensive value has played directly into SCHD's sector structure, and the dividend growth compounding over decades makes it the clearest long-term income machine of the 3. If your number 1 priority is maximum income right now, today, this year, this quarter, and you want significant real estate exposure that could benefit from rate cuts in 2026, SPYD is built for that job. But go in with open eyes. Your income will likely not grow meaningfully, and your total portfolio value after 30 years will be substantially lower than either of the other two options. If you want the broadest possible diversification, meaningful technology, and AI exposure through Broadcom, the lowest expense ratio at 0.04%, and the highest projected 30-year portfolio value, VYM is your fund. It does not win the income contest, and it does not win the yield contest, but it wins the wealth accumulation contest based on historical returns. And here is what I personally believe is the smartest allocation if you had $100,000 today and were within 10 years of retirement. 50% into SCHD as the core engine for dividend growth. It is dominating 2026, and the long-term income compounding is unmatched. 30% into SPYD as an income booster that bumps your blended yield meaningfully above 4% and gives you 25% real estate exposure that neither SCHD nor VYM provides. Exposure that specifically benefits from the rate cuts that the market is pricing in for 2026. And 20% into VYM as your diversification anchor. 570+ holdings, Broadcom's AI exposure, the lowest fees, and the highest total return of the three based on 6-year averages. This split is not choosing between growth and income, it is engineering both simultaneously. Your blended yield comes in above 3.5% from day one. Your income compounding comes from SCHD's dividend growth rate. Your capital appreciation gets a boost from VYM's Broadcom position and its broader market exposure. And your real estate rate cut upside comes from SPYD's sector tilt. Each fund is doing a specific job in the portfolio that the other two cannot replicate. Let me give you the final side-by-side numbers before you go. SCHD, currently around $30.82 per share, 3.3% yield, 0.06% expense ratio, 101 holdings, up 13.01% year-to-date, $30,300 in year 1 income, $39,175 in year 30 income, $1.93 million portfolio value at 30 years. SPYD, approximately $45.81 per share, 4.08% yield, 0.07% expense ratio, 80 holdings, up 6.68% year-to-date, $4,080 in year 1 income, but only $5,413 in year 30 income, $837,000 portfolio value at 30 years. VYM, approximately $148.54 per share, 2.26% yield, 0.04% expense ratio, 572+ holdings, up 4.72% year-to-date, $2,260 in year 1 income, $11,753 in year 30 income, and the largest portfolio at $234 million after 30 years. The differences are stark, and they matter enormously depending on your time horizon and your income goals. If income starts now matters most, SPYD wins the first several years. If income later matters most, SCHD wins every year after year 8. If total wealth matters most, VYM wins the 30-year race. Tell me in the comments which allocation makes the most sense for your current situation and why. SPYD, VYM, or a blend. I genuinely want to see where you land and what your reasoning is. If this breakdown gave you something useful, hit subscribe because next week I am going deep inside SCHD's March 23rd reconstitution. What came in? What got removed? Whether the changes make SCHD a stronger buy or create any concerns, and what it means for the dividend growth trajectory that makes this fund work over the long term. You do not want to miss that one. The best dividend ETF is not the one with the prettiest number on a fact sheet today. It is the one that pays you more 10, 20, and 30 years from now. See you in the next one.